All right, ladies and gentlemen, there we go. We are ready to begin. It is my great pleasure to welcome you to this flagship session of the World Bank Spring Meetings on FinTech and capital markets. We have an extraordinary array of talent here with us today for one of the most important discussions that is going to take place this week. Before we get into our panel, we are privileged to have Xiaoling Yang, Managing Director of the World Bank, with us. He is going to make some opening comments, and we turn things over to you now, sir.
Good afternoon, everyone. I want to welcome you to this engaging discussion on capital market development and the FinTech revolution. We know that for many emerging markets, this is a critical agenda that raises opportunities and carries deep policy implications. FinTech can support potential growth and poverty reduction by strengthening financial development, inclusion, and efficiency, but it may pose risks to consumers and investors, and more broadly, to financial stability and integrity. At our annual meetings last October, the IMF and World Bank launched the Bali FinTech Agenda, a broad framework of 12 policy elements that countries should consider in their domestic policy discussions on FinTech, including how to foster FinTech for development of financial markets, a topic of our distinguished panelists will talk up today. So why are financial markets so important for us in the World Bank Group? Because financing for development is critical, because the gaps are huge, and because creating market is a big part of the solution. This is a key element of our forward-look strategy toward 2030. In particular, efficient and resilient capital markets can help bridge these gaps, like the gap of 1.6 billion people lacking adequate housing, or $5.2 trillion in financing required for small and medium-sized enterprises in the developing world. Capital markets can help crowd in private capital to finance strategic sectors, sound local markets, protect economies from capital flow volatility, and reduce dependency on foreign debt. World Bank Group teams work diligently to help client countries strengthen local and regulatory frameworks and to improve innovative instruments and capital market solutions, but also to help them address head-on the opportunities and the challenges of rapidly advancing financial technologies. Indeed, many in the audience know well how FinTech is transforming business models across capital markets, enabling issuers to issue capital directly via platforms, allowing intermediaries to provide advice through automated means and the distribution of products via online platforms. FinTech is also being employed to scale up and attract small servers to capital markets. FinTech is increasingly relevant to capital markets infrastructure, providing new alternatives to financial market infrastructure in areas such as custody, clearing, and settlement. And FinTech has even changed how the World Bank raised some of its own capital. Last August, the IBRD Treasury issued the world's first global bond to raise financing from public investors in a transaction that uses blockchain from start to finish. The AAA bond, a 2-year issue named Bondi, raised 110 million Australian dollars from the bank's operations. It is the first time globally that the legally binding bond has been created, registered, transferred, and managed through its life cycle solely using decentralized ledger technology. The platform was built and developed by the Commonwealth Bank of Australia's Blockchain Center of Excellence with support from the World Bank Group's Innovation Lab. Bondi provides an opportunity for us to learn firsthand how blockchain can change financial markets and how it can be embraced for development, with a view to advising our client countries on the opportunities and the risks of new transformative technologies. In fact, our teams have already delivered 9 blockchain use cases across a range of sectors and 4 AI prototypes. To fully benefit from FinTech innovation and adoption requires a flexible policy stance that promotes an enabling legal, regulatory, and supervisory environment while being mindful of new risks, such as those related to the investor and consumer protection, data governance, money laundering, and cyber attacks. Today, we want to expand this discussion and call on all partners, old and new, to continue innovating with us. We want to amplify the voices and exciting work of those who are innovating in this space. And ultimately, we want to inspire those who have big dreams. We know there are challenges, and we are here to help. Because as we said in Bali, benefits of FinTech revolution belongs to the many, not just the few. I wish you a very fruitful discussion today. Thank you very much.
Well, we are extremely grateful to Xiaolin for that excellent scene setter, and I don't know that we could hope for a better introduction to our conversation today. As the bank's chief administrative officer, I know that he and Denny Robitaille, the vice president and CIO who are here, spend a lot of time thinking about questions of security, efficiency, accountability that are at the heart of some of the technologies that we're going to be exploring. My name is Tamika Tillman, and I serve as the director of the Blockchain Trust Accelerator and the Bretton Woods 2 program at New America. And we have brought together the dream team of FinTech to have this conversation with us today. I'm going to introduce them all briefly, and then we're looking forward to having a very open conversation over the next 90 minutes around how these technologies are going to shape the operation of institutions, how they're going to shape the evolution of economies, and how they're going to impact on individual citizens, which at the end of the day is one of the most exciting applications of these new tools. I'm going to begin from my left, your right, with Carolyn Wilkins, who is the Senior Deputy Governor of the Bank of Canada. We then have Greg Metcalf, who is the Director of Financial and Enterprise Affairs for the OECD. Greg is also the former chairman of IOSCO, so if you're involved in securities, you need to be on very good behavior when you hang out with Greg. We then have Stacey Warden from the incredible team at the Milken Institute, and Stacey is a dear friend and has been a leader in applying these technologies in frontier and emerging markets around the world. And then Richard Brown, the Chief Technology Officer of R3. And Richard, I want to start with you if I can. I was having a discussion recently with the Chief Strategy Officer of one of the largest financial institutions in the world. And he said the most important thing we are getting out of blockchain is not increased efficiency, it's not increased security, it's not increased transparency, although we're getting all of those things. The most important thing we're getting out of this new generation of technologies, financial technologies, is that it's forcing us to rethink the assumptions around the way our institutions operate. Is that true, first of all? And if it is true, why?
I think it is true. I guess to see why it might be the case, I guess we have to be really precise about what problem we think it is that blockchain in particular is solving, I guess we can then broaden to financial technology in general. If we look back a few months, January was the 10th anniversary of the launch of the Bitcoin network, as we all know. And we all know what happened from that, the innovation that flowed from that, but also the speculation, the energy usage, the good and the bad. But 5 years ago, something I would argue equally as interesting happened, because people began to say or speculate or even argue, assert without even any justification, that the underlying technology, the blockchain technology that underpinned Bitcoin and what came after it, could have a transformational impact for the regulated financial sector and perhaps business in general. But it took some time before that claim was formalized, if you like, and demonstrated to be correct. Because there's kind of like an irony at the heart of this whole space, that you have to make a case for why a technology that came to life just over 10 years ago, that was not designed to solve a single problem that a regulated financial institution has. Quite the reverse. It was intended to circumvent or even replace the banks. You have to make an argument for why that technology should also somehow have a transformationally positive impact on those same institutions. Now, the work of the last 5 years by firms such as my own, R3, with our member banks and other firms, has, I think, helped us understand why people were making those claims and to the extent to which some of those claims were true. And at its heart, and I think maybe this comes to answering your question, Tamika, is the thing that seems to unify both the speculative, exciting, permissionless public blockchains with what is being applied in the business sector is it's a new way of enabling people who want to transact with each other but whom don't fully trust each other to know for sure that they're all acting on the same data, that they all see the same thing. To put it simply, that when I look at my computer, I know for sure that what my counterparts, competitors, and trading partners see on theirs. So if you try and transition that thought process from the initial use cases of cryptocurrencies and things like that to the applications we're now seeing in business that we'll come on to, it's that step that allows us to know our systems are in sync that enable two things. One, it enables us to reduce and remove a huge amount of cost, duplication, error. Not exciting, but important. But it also enables new opportunities because we're now sure that we're operating on correct data. We can act more quickly. We can act with more confidence. But the key point, and I guess this is why the answer to your question is yes, is that for this to work, this technology has to be deployed at the level of a market, at the level of an industry, not necessarily at the level of a firm. All trading partners need to adopt it. And therefore, the amount of collaboration, standardization, elimination of unnecessary differences and deviances between these firms' processes and operating models is a key part to getting the technology deployed. And it's that process change, that it's not exciting, but that process change, that improvement, that standardization and removal of divergence, that's a key part to driving this efficiency and enabling these new opportunities. In short, and maybe to conclude, a key part of this is identifying all the places where we can get things wrong, where things can get out of sync, where we might not be operating on correct information, and systematically, progressively, and just relentlessly identifying and eliminating each one or bringing it further forward in the process. So net, I think the person you spoke to was correct. It is having a transformational impact of the sort you say, but we do have to be quite precise about what the technology does and what it doesn't provide. It's quite nuanced where I think the benefits are.
It's an excellent point, and building on that, Carolyn, I want you to tell us a little bit, if you can, about the work that the Bank of Canada is engaged in using some of these technologies. Project Jasper has been one of the first moments in which a big central bank has started to apply these tools. I'm sure there are lessons from that experience. Tell us what you're seeing as you move forward.
Sure. Well, part of the motivation that the Bank of Canada had in exploring a particular set of technologies, distributed ledger technologies, was exactly what was just said. it wasn't so much we thought we need to bet on this technology in and of itself, but rather it was an open door to thinking about how to do business differently. And of course, one of the core responsibilities of central banking is payments. And so we did 4 separate projects called Jasper, treating different aspects of the payments chain. One was the interbank payments, large value transfer system. We actually partnered with R3 on that, as well as Payments Canada. We did another project with security settlement, and we're in the process now with cross-border payments, and that's in conjunction with a couple of private sector firms, as well as the Monetary Authority of Singapore. The thing that's most interesting about the last project is really it builds on the lessons from the first couple, which is, well, first of all, we're probably going to need a closed permission system if it's going to be anything so central. But also you need to, even though the systems will work, you really need to add assets or go more end-to-end in terms of the processes to reap any of the efficiency gains that you can expect from this kind of technology. What's interesting about the cross-border payment project is that it's able to pair 2 different DLT systems. One is Corda and the other one is Quorum, and kind of solve the problem of cross-border payments that requires correspondent banks, right? So you have correspondent banks, a lot of costs, a lot of risk mitigation there, but a lot of costs too. I don't know whether you know, but cross-border payments are 10 times more expensive for businesses and people, just individuals, than
Say that one more time, because I want to make sure people let that sink in.
Now, it's not for nothing, because you need the correspondent banks there and others to make sure that all parts of the transaction either settle at the same time or none of them do. Otherwise, there's too much risk. And so, in the project we're doing with the Monetary Authority of Singapore, there's this hash time locked contracts. I'm an economist, so I have to look at it to make sure I get it right. But what it's doing is it's using smart contracts to kind of have that finality of settlement, that everything settles or nothing does. And so we're not quite finished that project, but certainly the results are very positive. I think the final thing I want to say just before passing it on is that we have to remember with experiments like this that they really are proofs of concept. They're not a full ecosystem for any of the payment solutions that we're trying to get. You also need to pass this, kind of look at how it would work at scale. You need to look at the legal issues, the regulatory issues. But it's a really good start to see how we can think about payments in a different way that's more efficient, that's safer, and at the end of the day serves customers better.
So building on that, I want to touch on 2 points next with Greg and Stacy. One is regulation, and then the other is the application of these technologies in frontier markets. Greg, you have an unusual perspective on these issues. You have seen how securities markets work at a global scale. You also know the potential of these technologies, and that potential, as with any new technology, goes both ways. There are some great things you can do, but there are also some very problematic implications. What do you think about when you look at these technologies as a regulator? And I'm getting old, but I have pretty decent eyesight. I can see the color draining out of the faces of some of the regulators in this audience as they think about what this is going to mean for their workload going forward. What should they be focused on, and what do they not need to worry about as we think about how to apply these tools?
And I'm happy to say that also I spent 30 years as an investment banker, so I've seen it from both sides. But don't worry, it's about harvesting the opportunity, mitigating the risk, okay? So I think from what we've heard from Richard and Caroline, FinTech does hold huge potential to transform finance and capital markets for the better. Blockchain and big data analytics, artificial intelligence, and I think also, we all know, widespread internet connectivity, I think is set to do 3 things. One is increase the efficiency and the speed in payments and asset transfers, and that's a little bit what Carolyn just touched on. Secondly, tailor advice and products cheaply, I think to an unprecedented degree. And then thirdly, as we've seen, enable new business models and, most importantly, spur competition, which I love as an ex-investment banker. Well, a little bit. But at the same time, there are risks as well. In keeping with the blockchain, the DLT examples, cryptocurrencies and initial coin offerings have demonstrated just how fast technology can move from too small to care to too big to ignore. And I certainly saw that as chairman of OSCO when we first talked about ICOs a few years ago. We said there's nothing to see here. And suddenly, within 18 months, there was a lot to see. So regulators and rules have struggled to keep up, and we have seen a host of market integrity issues with ICOs, from money laundering to investor protection and outright fraud. So my message to regulators is it's a bit like being an investment banker. You've actually got to be ahead of the game and got to understand if you're going to be able to react. So that's an important lesson. But beyond blockchain, the OECD has been looking at novel challenges in data-driven financial markets, like the potential for algorithms and AI to collude in financial markets. Been looking at the issue of discrimination and exclusion with algorithms, so there's issues related again to AI. We've also been working closely with the G20 on digital financial education, which FinTech, you know, you think about it, we do need consumers to choose and use these new financial products appropriately, okay? And it's all part of, you know, the FinTech equation. So, but on balance, FinTech's benefits to consumers and businesses, I think, are well worth managing those risks. So, you know, regulators, as I say, are at the front line in managing those risks and ensuring that FinTech developments can translate to positive market outcomes. As I said, harvest the opportunity, mitigate the risk. And so I'd just like to take a few minutes to lay out, I think, 5 lessons that are really emerging from the OECD's research into, for example, DLT applications in capital markets that, in fact, have come from our Blockchain Policy Centre. Secondly, our co-chairing the FSB Decentralised Finance Workstream, and then a number of years just, you know, investigating and researching impacts of digital finance on markets and consumers. So, firstly, FinTech does not change market fundamentals, okay? There's nothing fundamentally has changed. And regulators... A lot of people
very disappointed to hear you say that.
Yeah, okay, that's why I said to be relaxed.
It's true. It's
but regulators should focus their policy interventions on achieving their mandates. And I know from when regulating, whether it's high-frequency trading or robo-advice, this was always my fundamental, get back to basics. You know, we're concerned about making sure that we have fair and efficient and orderly markets. That's your fundamental mandate if you're, say, a market regulator. So I think focus on the fundamentals, and that does mean things like financial stability, business conduct, consumer protection, literacy, and markets efficiency. So fundamentals don't change. Secondly, very importantly, look to use your existing rules, your existing toolbox. You know, we often see that issues raised by new FinTech products or business models are often already addressed elsewhere. And it's a bit like with initial coin offerings. You know, basically I said, well, basically it looks like a securities offering, feels like a securities offering, probably is a securities offering, even though there was a debate about whether they were or not. So use your existing tools and perhaps don't listen to perhaps what third-party lawyers are telling you. So just focus on the economic function of the product, not the technology behind it. We need to move away clearly from regulating institutions to regulating activities. And I think that is one I think we all know today, that's where things are. And also, it's really important to think about proportionality is also an important consideration. You know, small fintechs have a very different risk profile to a large bank. The third thing is that regulatory certainty is important, but it's a fine balance. If there is a need for new rules or guidance to cover emerging technologies, these, again, as we always say, should be technology neutral, and most importantly, they need to be principles-based, because things change so fast these days that if it's not principle-based, you're going to have a problem remaining relevant. You know, we do need to take a long-term view. Technologies like blockchain will certainly be different in 10, 20 or 30 years than it is today. So you need the approaches to be flexible and to grow with the technology. So in fact, some cases, innovation could be actually revealing areas where our regulatory frameworks are actually not technology neutral and may constrain innovation. So it could go the other way. The fourth thing, back to my first comment, regulators need to build capacity and understanding of new financial technologies. Now, I think this is really important if you want them to respond appropriately, rather than rushing in with market interventions that may not be necessary or could have unintended consequences. So what that means is you've got to engage with industry and FinTech hubs that have been established in many regulatory jurisdictions have proved, I think, extremely valuable, and that's happening around the world. And then finally, the fifth lesson, I think, is clearly cooperation between agencies within jurisdictions, but then cooperation between jurisdictions is also critical, because often regulatory agencies often sit at arm's length from government, but FinTech is actually posing challenges that often sit outside of their mandate. So, for example, competition policy, privacy, and data governance, regulators actually need to connect the dots to make sure they're looking at this holistically at home. And then equally, as I said, internationally, you know, regulators do need to learn from one another. And it's critical that they compare notes and experience. Because if you don't, what you're going to have is regulatory arbitrage or regulatory fragmentation. And obviously what that means is it potentially limits the benefits that you can get from the potentially huge FinTech transformation.
Well, that is a formidable list of learnings, and we'll dive into a number of those topics in greater detail over the course of our conversation. I want Stacey for you to help us understand something pretty profound about these technologies. I was sitting down yesterday with the Deputy Governor of the Central Bank of Cambodia, who's here with us in the audience today, and learning a little bit about the work that they are going to be doing over the next few months using FinTech to accelerate payments. And the infrastructure that they'll be putting in place is as sophisticated as anything that you'll find pretty much anywhere in the world. Frontier markets are going to be in a position to harness these technologies in some very unusual ways, in part because they're not necessarily encumbered by legacy technologies. And you and your team at the Center for Financial Markets at Milken think a lot about those dynamics. What are you seeing in places like Rwanda where you've been engaged? And what's the opportunity for leaders in emerging and frontier markets to maybe leap ahead of some of the legacy systems that those in the global north have been using for a long time?
Okay, well, am I on? Oh.
You are indeed.
Okay, thanks, Micah. And I feel as though, because most of the world's population is in developing countries and emerging markets, I should get the majority of the time on this panel to speak.
Duly noted.
Okay, so part of the reason, of course, why these opportunities are in emerging markets is because the infrastructure of capital markets and financial markets is not as good, right? The information environment is not as good. The institutions that you need to have are not as good. But I would argue, and I would disagree with you a little bit, that it's not so much that, and I guess I would agree that FinTech can't make up for, can't substitute for market inefficiencies, but in very important ways they can kind of make up for them. And I'll talk a little bit about that. But the second way that I think emerging markets can kind of leapfrog is simply because it's hard to do things. And it is adversity that brings innovation, not comfort, right? I mean, when I moved to London in 2003, I was like, all these people are texting each other. Why is everybody texting? But you know, the cost of phone calls was much higher in Europe than it was in the United States at the time, and so it was just a much more natural application. And so the kind of the theme of these remarks a little bit will be that there's problems in emerging markets, but also these problems are opportunities. So for example, 70% of 600 million Asians, so this is like 500 million Asians don't have access to a bank account. 500 million people with no access to a bank.
That's 70%, you said?
Yeah, 70%. And, you know, the world average is like 30%, so it's particularly bad in Asia. You know, in India, 40 to 50% of the bank accounts are dormant. So this idea that financial inclusion has to start with the bank account needs to be questioned, actually. You know, the second thing is that there's a billion people, 1.1 billion people in this world without identity that they can prove, without an ability to prove KYC, and you are not going to participate in the international correspondent banking system if you can't approve your identity. So that means you've got to find ways to prove your identity, or you've got to somehow get around the international correspondent banking system. And FinTech entrepreneurs are looking at both of those things.
Stacey, because what you're saying is extra fascinating, I want you to hold the mic a little bit closer.
Okay,
so
all right, so there we go. Okay. So on the sort of the flip side of that coin, though, is that this leapfrogging has already started, right? So 71% of the global population will have mobile phones by 2025, and that will be driven by developing countries. In Africa, 21% of all payments are made on mobile devices, which is much higher than the world average. And I think a good example that kind of, you know, talks about all of this is the Philippines, right? The Philippines has one of the highest mobile phone penetration rates in the world. They have over 90% mobile phone penetration. At the same time, they have 7,000 islands, and at the same time, 90% of transactions are conducted in cash. It makes absolutely no sense. It's an environment, and we've been working with the Philippines, so I know this example of how can you bring FinTech solutions to make that to sort of help with that financial inclusion. So, you know, the World Bank sent around a little email ahead of time and said, you know, kind of give us some ideas for talking points. And then my talking point was that, Stacey, maybe you could talk about how the emerging markets are kind of the barbarians at the gate on this. And you know, what does that mean? And I wrote back and I said, barbarian at the gate? They have opened the gate. They have driven up the driveway. They have parked their cars. They have picked the lock on your front door, and they are sitting in your living room, you know? I mean, so let me just say how this disruption is happening, and if you think about it from a kind of a taxonomy of things, I'll start with the Mac Daddy of them all, which is, of course, payments, right? So let me tell you the story about M-Pesa in Kenya. No, I'm just kidding. I promise I am not going to tell the story about M-Pesa in Kenya. In fact, if you don't know the story of M-Pesa in Kenya, I want you to get up and give your seat to somebody else who's sitting down. You don't have a right to be in this room if you don't know the story of M-Pesa.
Stacey, can you hold it like this?
Okay, sorry.
I'm getting.
Can you hear me? Can everybody hear me? Raise your hand if you can't hear me.
Hold it straight up and down.
Okay. Oh,
there you go.
There we go. Okay. All right. But it is worth noting about M-Pesa that it started in 2007. 2007, 20 million people use that platform right now. And it is worth noticing, with no disrespect to my fellow panelists, that the reason M-Pesa got off the ground in Kenya is because telcos are not regulated by the central bank. So they got a little bit of regulatory runway in the beginning to develop. Now, in Asia, it's even more interesting, because in Africa, this stuff is driven by the telcos, but in Asia, it's driven by the e-commerce platforms. And so this is what they're calling now tech fin, if you really want to be up to date on the lingo. So you've got your FinTech and you've got your tech fin. And in China in particular, they are following customer experience. So GrabPay, I mean, this is a ride-hailing company in Singapore that is making payments because they start with what their customers want. Well, first they want to pay for rides, and maybe they want to pick up something when they're paying for their rides. Maybe they want to pay for other things as long as they're paying for their rides. They're starting with this kind of customer-centric mentality, and that is what's driving business. And the evolution there has been from closed systems. I won't go into the details of that, but you can think of kind of PayPal closed system to now system to cash. So Echo in India, for example, is really doing a nice job working with small stores so that Indians can send remittances from cities to rural areas and pick up cash and deposit cash back into that system. And also platforms that allow systems to talk to each other across the top. Two really profound implications for payments is, of course, remittances, which we've already discussed. 5% fees to send a remittance. It is outrageous. It's outrageous. And it's not just the price. It is the lack of transparency. So Transferwise, which was one of the early players in this, they price at the midpoint. That's all they do. That was their entire innovation, was to price FX at the midpoint. And if you look at their advertisements, all they talk about is how we're transparent. You know how it's pricing. It's not necessarily cheaper, but it's just more transparent. And BitPesa is a very big player in Africa that is avoiding the correspondent banking system kind of altogether by transferring into Bitcoin, and so that you can make these peer-to-peer. If you want to go from Kenyan shilling to Japanese yen, you transfer into Bitcoin over the blockchain, and then you're back, and you avoid this string of correspondent banking all over the world. And about, I would say, 33% of FinTech companies are in this payment space. Okay? So now, if you follow your customer and you follow it from payments, what are you going to go to next? You're going to go to savings. And here, FinTech can help with micro savings. This is bottom of the pyramid type stuff. Ghana is now allowing interest on its on payments on mobile savings. You can now pay interest. Now, I don't want to say women are better than men. I'm not saying that. I'm just saying that in one way in which women are better than men is that they spend their money a little bit better. So especially in developing countries, women tend to make payments on food and fruit and vegetables, 15% more. Education, 20% more. And so these payments and these savings also in certain countries help women keep their savings away from husbands and brothers, just to put it sort of bluntly. And this can be very important for social equity and for inclusion. And then when you think about savings and you're following your customer, what do you go to next? You think about investment. And again, it's micro investment, it's gamification of investment, right? How can you kind of nudge people into doing the right kind of savings behavior? And it's also, if you use AI, then you have AI for asset valuation, and that uses generative adversarial networks. And the reason I am bringing up generative adversarial networks is because I know there's a lot of cocktail parties later on today, and I want you to be able to throw out something really super cool. But that's all I'm going to say about that.
Use the term generative adversarial network.
I'm telling you, it is a winner. You meet somebody in the opposite sex in a bar, and you just throw out generative adversarial techniques, and it's just really a winner for you. Okay, the last
Who said you don't learn anything useful at the World Bank Spring Meetings?
Okay, I am going to shut up after I talk about credit and insurance just for a minute. So credit, I think everybody knows this. When the information environment does not work, you do not have credit agencies, then other forms of actuarial scoring and credit become very important. And so that's where these kind of small credit, these FinTech credit players are really looking at other ways of assessing credit. I'll tell you one, I think it's kind of a scary story, or it's an interesting story. A platform will give you credit if you refer somebody. They'll give you kind of points if you refer somebody onto the platform. But if the person that you refer doesn't pay, then they will penalize you. So they use these kind of social network type scoring. They're looking for ways to score credit worthiness in an environment where there's not a lot of information. The other thing, though, is it's not just about assessing credit. It's also about enhancing credit, because FinTech allows you to take payments at point of sale. So it improves the credit worthiness. Blockchain is very interesting credit enhancement, because if you've got your car on the blockchain, and the blockchain can kind of talk to, in IoT, can talk to the real world, and you miss a car payment, well, your car can just be turned right off. You can't drive that damn car. And so I have a terrible credit history. I mean, I don't personally have a terrible credit history, but I have a terrible credit history, and I want to make car payments. Nobody's going to give me a car, but if it's on the blockchain, ironically, it makes it easier for me to get a car, because they know they can turn that car off when I don't make my payment. And last, I will just briefly touch, and credit is about 42% of FinTech companies. Last, I'll just talk about insurance, because insurance is very interesting because it goes with monitoring. So it's much better. You can have crop insurance with satellite technology that can actually monitor crops. A very interesting example with All Life in South Africa. South Africa has a 27% AIDS rate. You cannot get, it's very hard to get insurance in South Africa. And if it's hard to get insurance, it's hard to get everything else. Bank accounts and credit and payments and stuff. So what All Life is doing is using technology to monitor, are you taking your AIDS medication? And since they can monitor that, they're willing to insure for that. And that helps, you know, you in financial inclusion for all other products. I have, you know, 4 or 5 more pages of things to say, but I will stop there and turn it back to our moderator.
That is an impressive list, and I'm hoping that we can use it, as is the moderator's duty, to touch off a bit of a debate between our panelists. Stacy has just given us a really compelling argument for how these technologies are going to impact life at the bottom of the pyramid, how these technologies will change dynamics for individuals that are at the moment on the margins of a lot of global markets. Your firm has done a huge amount of work with very, very big players. With financial consortia, R3 is one of the largest and most important players when it comes to changing the way that banks and institutions are operating among each other. And yet you acknowledged in your comments at the outset that we are in an unusual moment because these technologies were originally developed at some level to disintermediate financial institutions. Where is the impact of these new tools going to be felt most? Is it going to be at the top among the incumbent institutions who will gain a variety of new mechanisms for engaging in trade and settlements? Or is it at the bottom where people are going to see the tangible aspects of their lives influenced in new ways?
I'm not sure it's either, to be honest. So when we started back in 2015 now, it was exactly as you said. You know, we began as R3 as a consortium of dozens of the world's largest banks. And our focus wasn't even that broad. It was primarily the dealer banks. We were looking at you know, sell-side securities processing, derivatives, and to some extent payments. And I guess it was a serendipitous experience. I guess maybe I'll look back one day and realize it was a once-in-a-career event. We discovered after several years of building the Corda platform, which is the open source blockchain that we built, we realized, and I guess it was, as I say, it was serendipitous, that this thing we thought that had been built specifically and solely for solving problems, large-scale problems for regulated financial institutions, was actually far more broadly applicable. Now part of this was we discovered this because of a strategic decision we made to make it open source so other people could discover it and use it. But what we discovered was people were using it in insurance, for remittances. There's one example right now for remittances from Saudi Arabia back to India, oil and gas, healthcare. There are people who've independently discovered it and are now deploying it. So as an engineer, as a professional engineer, I'm delighted that people have picked this up and are using it. But now as I zoom out and look at what they're using it for, and the reason why I said I'm not sure it was either of your examples, Tamika, is in the financial side and the large corporate side, where I'm seeing it and other enterprise blockchains being deployed are to solve niche, very high value, but niche problems that previous technologies couldn't solve. So to give one example, the syndicated lending market, which is hardly niche, but it's just a subset of the overall financial markets. The technology is being used there to massively improve the flow of communication between the lenders and the agent bank on behalf of the borrower. So quite a simple problem being solved because the information just doesn't flow correctly. But the reason it doesn't flow is because it's an inherently decentralized market. You know, there's no CEO of the syndicated lending market. There's no one body who could have enforced change. So it was only when this technology became available that allowed you to deploy a solution amongst all the firms without adding new points of control, new intermediaries, that it became possible. And I guess it's kind of obvious in hindsight, but the reason I call it a niche deployment is until this technology arose, there wasn't a technology that could fill that gap in the syndicated lending market, and therefore there was a genuine new problem to solve, a new opportunity to go after. As opposed to what I perhaps naively thought would happen 3 years ago, which is there would be wholesale re-platforming or re-implementation of existing systems. That will come. We can see what's happening with one of our peer firms in Australia with the re-platforming of ASX. But the really interesting opportunities and projects I'm seeing are hitherto unsolvable problems now being solved by this technology. And then at the smaller scale, we're seeing individual startups or individual groups of firms discover the software because there's a free version. They use that, and we see problems that we never would have anticipated, such as the remittance corridor from Saudi Arabia to India, as I say, being solved. But maybe just one other comment, because I really enjoyed your points about specific usages in Africa and elsewhere. There is a risk of almost fetishizing the technology. So we see all these either these cool startups or interesting ideas that have been applied. And what I sometimes see is those whose job it is to either make sense of it or who are responsible for deploying it in a new context, perhaps because it's sometimes it's complicated, or because it seems like the people pitching it are so passionate. Sometimes it's difficult to question them, and to your point, insist on the application or the imposition of certain principles. So if we look at again back to blockchain, because that's my area, the first generation platforms had a principle of all data was sent to all people. There was no identity layer. There wasn't settlement. There isn't settlement finality. The job, I would say, of the people in this in this atrium and watching this is not to accept these technologies in their current state as a given, but to say that's interesting. Perhaps these can be used to solve the problems we're trying to solve. But these are the non-negotiable requirements we have, and we shouldn't have to we should sort of change our requirements and principles to fit the technology. The technology should be shaped to meet our requirements. And I say all that because you mentioned the same old tired M-Pesa use case. But I think what people often miss about that is what quite a sophisticated and unexpected use of really quite an old technology in the GSM and SIM card spaces. This wasn't just a naive application of existing technology from a developed market into Kenya or Tanzania. It was a very sophisticated understanding of how a particular feature in that infrastructure could be used given the constraints of that market. So it was exactly, I think it was an exact example of this principle of, this is the problem I'm trying to solve, these are my requirements, these are the things that are non-negotiable. How do I conform the technology to this rather than the other way around?
So we've heard from Richard and from Stacy some very exciting discussion around the opportunities associated with this technology. Richard used the term unsolvable problems being solved, which is, I don't think, overstating the case. And yet we're also starting to recognize that there's some concrete risks that go along with deploying these new tools. Some of that is in the realm of irrational exuberance, where people will claim that blockchain will end death and cure tooth decay, which is obviously not going to happen. But some of it also involves systemic risk. Here we have a great team at New America that I'm fortunate to work with that engages asset allocators around the world. And today they released a new list of the world's 200 most responsible asset allocators who are tackling non-traditional risks associated with environmental, governance, and social concerns. What are the non-traditional risks that exist in the realm of fintech? What are the things that, just like we're seeing large asset allocators shift their behavior probably a few decades later than they should have to account for a new generation of non-traditional risks that are being identified by a wide range of actors? What are the non-traditional risks that could theoretically come and bite us if we're not thoughtful in the deployment of these new technologies? Carolyn?
Sure. Well, the first thing is it's so exciting and just amazing the kind of services that can be provided to people who don't have those services today, and it just makes such a big difference to their lives. And it's great to see that companies have found a way to, and innovators have found a way to gain the trust of the people who are using those services. It's another thing to be able to keep that trust. And that's where we need to think about what are those risks and how many of them are new and how many of them are actually good old-fashioned risks. And I would actually say the new thing are the players. Maybe the new thing is some parts of the technology, some parts of the business models. But in large part, the risks are the same. And I would start with trust. Many people who love blockchain, although not all people who love blockchain, will say, well, it kind of eliminates this need for a trusted third party. And my view is, actually, it doesn't. It just changes that trusted third party from one place to another. We saw that in our Project Jasper. You see it in the exchanges that are needed to transact, say, with cryptocurrencies. And you see it in other places. And so I think we have to stretch our minds and think about trust in that way. And of course, the classic way to deal with trust issues are clear governance, clear transparency, accountability, liability, as well as, in some cases, fiduciary duty. And one of the interesting aspects with blockchain technology is especially the open source blockchain, like for Bitcoin, is that the governance is really kind of non-existent or loose, if I could put it that way. And so what that means is, while you might think a programmer of this technology has some duty, you need some way to approve upgrades or be transparent about bugs in a program. I'm just using that not by hazard, but because it actually happened. You know, it really does raise the issue, can you trust that underlying technology and the outcomes that it's going to produce for you? That's just one example. Another one is outside of DLT, but with respect to applications of artificial intelligence and machine learning to the programs that allocate credit, the credit scoring models. They're amazing in terms of being able to create access and efficiencies, and maybe they're even better allocators of credit. But what we haven't come to grounds with is whether all these programs do what they say they're going to do and whether they do it in a way that is ethical. And again, that's about trust, because in developed countries as well as developing countries, these programs can make choices that we may agree with, but may also leave people kind of confined to their silo and you know, impede social mobility and all those things. And so I think some of these bigger questions that are not traditional kind of leverage, liquidity, and capital kind of questions, they've always been there, but I think we need to revisit them. I guess the last thing I would say that's related to risk is one that you touched on, which is concentration. A lot of these technologies have natural economies of scale and economies of scope. So you have big companies that are tech companies and others who have market power, also maybe becoming too big to fail, but also are not subject to the same regulation. And that may be fantastic in the first wave of the cycle to allow the innovation to occur, but as it matures, it may mean that they get the monopoly rents and they gain from it when it goes well, but it's governments and ultimately all of us as taxpayers that end up paying for it. And so that's another issue that I think needs to be addressed.
So that's a wonderful set of themes. And you know, Greg, I want you to help us, if you can, dive in a little bit deeper around this concept of trust. One of my favorite authors is Yuval Harari, and he asks a basic but fundamental question, which is, why do human beings run the world? And the answer that he comes back with, because he says it could be jellyfish, it could be orangutans, there's no obvious reason why we're the ones in charge. The answer he comes back with is that ultimately we're the only species that combines two attributes. We can cooperate flexibly and we can cooperate at scale. And the way that we have done that historically is we have entrusted institutions, either financial institutions or government institutions, with serving as custodians of the facts on which we base our lives. And then once we all trust those facts, once we come to consensus around the validity and the veracity of those facts, we're able to go out and build cities and civilizations and companies and do all of the other things that we do. But that really is our superpower. And the potential of FinTech and the potential of these technologies, if we get them right, and it's an open question as to whether we will get them right, is to create a new chapter in that story of trust, enable us to write a new narrative around how we come to consensus on those basic facts that undergird the decisions that we all make every day. Do you think that that is a realistic course forward for this technology? Is that overstating the case? And if it is in fact correct, what role do regulatory bodies have to play in accelerating that? Because you mentioned if we go too far, we can actually inhibit the work of innovation that is necessary in order to realize this potential.
So, look, I agree with Carolyn's comments. It is all about trust, but it's in a different lens today. And that's why I think when we look at, I said before, you should always go back to fundamentals in terms of how you approach the problem, because in a way, it's not that complex if you go back to, if if you're a competition regulator, you should look at your basic principles and go, well, actually, to Caroline's last point, is too much of the consumer surplus being taken by the new FinTechs? Okay, and that's a debate that's going on at the moment amongst competition regulators around the world. And on one side, it's yes, FinTechs are making, big tech, for example, is making a lot of money, but is that because they are investing a lot of money, therefore they're recovering? And it's actually indecisive at the moment, okay? So therefore, before you start challenging whether you trust what they're doing, you've got to get the facts right. And the same thing if you move into financial regulation, as I said before, whether it be markets regulation or in consumer protection, the fundamental thing is, markets, it's fair, orderly, transparent markets, and then making sure that the consumers and investors have trust in markets. And I think that's always got to be a benchmark. So when you see innovations, I guess I said, harvest the opportunity, mitigate the risk. You can't eliminate the risk, but you've got to make sure that you balance it with making sure that, you don't allow innovation. You can allow startups to test ideas, for example, which is what regulatory sandboxes are about, but you don't want to have a situation where you open the gates because too quickly, because suddenly things get out of hand and you have sometimes adverse consequences and people lose trust. And you then lost potentially what might have been a great idea gets trashed. Now, I think initial coin offerings are a good example of that, where I think they're a good example of a new way of raising capital for SMEs. They went wild, and now we're seeing the sort of consequences where basically, there hasn't been much activity for some time because we've started to have lots of problems. So I think it's about getting the balance right, but keeping an eye on maintaining that trust. So, I think it's a matter of balance. Harvest the opportunity, but make sure that you don't take your eye off the ball if you're a regulator in terms of your fundamental mandate. And I think that, but have an open mind. But also, as I said, you've got to be learning. I mean, to be a good regulator, you've really got to be, you've actually got to be on the front line. You've actually got to be there and be engaging and understanding and going, well, actually, if they do this, okay, this is how, for example, responsible lending, okay, I think we can get there by them doing this. So you can have a proactive approach in terms of engaging with it. So, but I think that, that's what, and there is a new set of problems, as I said, in markets with trust today, with data. I mean, one of the big areas I think is, that's emerging clearly is privacy and use of data, and data governance seems to be the big issue today. And I think it's the right issue. For example, we talked about algorithmic collusion, we talked about algorithmic exclusion or discrimination. I think there's sort of some of the new issues that are emerging out of the digital economy, and I think we're going to hear a lot more about them. And again, thinking about basics. So hopefully that answers your question.
Absolutely, that's very helpful. And Stacey, building on this, I want you to help us unpack some of these big normative questions. You spoke about the barbarians at the gate and the fact that we are seeing a real rapid transformation in the way these technologies are seeing different sectors of the economy operate. What should be the end goal as we welcome this new wave of innovation? Since we've opened the gates, since the barbarians are coming in, since we are changing the way that we do business, innovation to what end? What is it that we should be pushing for as we think long-term and look decades into the future around the evolution of these new tools?
Total world domination?
Not what I was expecting, but... Yeah.
Now, let me say a couple of things about risk, and then I will answer your question very succinctly. I cannot agree more with this idea of algorithmic exclusion risk. I think this is the biggest issue facing us. And just to say two sentences about it, you make an assumption about somebody in some way, and then you only show them things that conform with that assumption, and then you get yourself into this circle where they only, say, buy things that you only show them, and then you confirm your assumption. And as a corollary risk, though, what is the liability of the platform? right? The owner of the platform, even though it's completely algorithmically driven, very interesting case. I think the second big risk that I worry about is this kind of privacy, China, this social score, big brother type stuff, very, you know, meta risks that I think we're going to have to confront. In terms of blockchain, I think there are two risks that I personally worry about. One is, of course, right to be forgotten. When I talk about blockchain and identity with any of my African American friends, they're like, what? Really? No, you know, because we have been kind of, these stuff has been used against us for all time in this country. And no, we're not going to give you another reason to like not let me forget that I had got a speeding ticket when I was 16 years old. And then secondly, with respect to blockchain, rule-based systems are awful when you want to break the rules. And anybody that lived through the global financial crisis with big institutional asset managers that had rule-based selling algorithms, and my central bank clients even had these, very much regretted those, because there were times when you just want to ride it out and you don't want to. And I think rule-based monetary policy is kind of crazy. Now, it's less crazy in Venezuela, obviously, right? But it is, you know, the Marshall Islands want to have this new currency, and, you know, I think that they're going to regret it when they do. So those are kind of the big four that I worry about that are a little bit more not mainstream. Of course, you've always got, you know, illicit flows and investor protection and all the regular stuff. But what I think the point of this is two things. It's financial inclusion. Digitization and identity and financial inclusion is a fundamental right of every citizen on this planet. I could not believe that more firmly, and I think it should be baked in to everything that the World Bank does. The second is access to credit. You are not going to grow as a country and as an economy unless you can figure out a way to get credit into the private sector. And in too many countries, you got 6 guys at the head of banks. And I think financial stability is very important, don't get me wrong, but you got 6 guys making all the credit allocation decisions in the country. And you've got banks out there charging 2% on deposits, earning 15% on government paper, and going to play golf at 3 o'clock in the afternoon. And this is not how an economy grows. And so I think, to answer your question, I think it's about improving financial inclusion, it's about improving identity and personal usage of identity, and it's improving access to capital for the private sector.
So we're going to turn to the audience for questions in just a moment, but before we do that, I want to do one lightning round with all of the panelists. We are here in 2019. We had a great discussion about Bondi and Therese Couture and York Rhodes, who helped make that happen, among many others here at the bank, are in the audience with us today. We have seen some of the early stages of how this technology is being used in applications like Project Jasper. We've talked through some of the regulatory challenges and how this is impacting the work of big institutions in the global north, of emerging markets and developing economies and citizens in the global south. In 5 years, when the bank holds spring meetings in 2024, there's going to be another conversation. And the themes are going to be analogous, but the substance is going to be a little bit different. And I'd like to start with you, Richard, go down the line. What is going to be on the agenda in 5 years related to FinTech and financial innovation? What are the themes that policymakers in this audience should begin thinking about today in order to ensure that they are ready come that moment?
I guess a couple, maybe 3 thoughts come to mind. So the first one is, I guess it's what might we regret in 5 years not having done now? And I think one of them is, because there's so much excitement around so many different technologies right now, we kind of have to every so often just remind ourselves that we're grown-ups, we're adults. There's no such thing as magic. And so just because somebody waves the magic blockchain dust or the magic machine learning dust or whatever it is over a piece of technology, it doesn't change the fact that it is just a piece of technology. It is just a piece of software that somebody has written. So we shouldn't allow our critical faculties to be disabled because there's a shiny technology associated with it. That technology will be commonplace in 5 years' time, and whilst there may only be a few high priests who understand some of them today, it will be well known by many people in 5 years' time, and we'll feel slightly silly if we've given people too much leeway without applying principles, as Greg says, and being very clear about the problems we're trying to solve. And just to pick up on your point, I mean, this idea of how you can adversarially attack artificial intelligence, it's not theoretical, it is real. There are examples of, from a discriminatory perspective, I mean, they're just anecdotes, but they're real, of artificial intelligence-powered hand dryers that will only dry your hands if your skin is white, because they were the only people it was tested with when it was first built. But it gets worse than that when you look at AI applied to self-driving cars. So as people responsible for commissioning or approving this technology, we shouldn't give it a free pass just because it has a cool-sounding name. But the second thing is, in 5 years' time, these technologies will have been rolled out at scale. So take blockchain, because that's my area. There will be large-scale deployments of Corda and other platforms. The syndicated lending project I talk about, by then, it won't just be improved information flow. It will have enabled, assuming you are successful, secondary trading of syndicated loan tranches, hopefully reducing interest rates, increasing the liquidity of those tranches, a net improvement for everybody. Similarly, maybe the reinsurance market in Europe will have been improved. The Swiss stock exchange will have rolled out their digital exchange. I mention all that because in 5 years' time, it will be time to upgrade. It will be time to upgrade the applications, upgrade the underlying platforms. So again, today, we need to be planning for that, plan for success. And if we're now moving to a world where we're trying to optimize entire industries, not just individual firms, how you deploy now so that you don't end up with something that's completely sclerotic in 3, 4, 5 years' time when it is time to upgrade, it is critically important. We have to plan for success, and that also means we have to plan to make sure that we don't box ourselves into complete obsolescence.
Fantastic. Stacy.
Okay, two things that we will not be talking about are, we won't be talking about the competition between banks and FinTech, because I think the path is to cooperation, and they both are trying to solve the same thing, and the tie-ups that are happening now are going to accelerate. The other thing we're not going to be doing is throwing the word blockchain around to everybody that has a database idea. So we'll have a much better understanding of what exactly blockchain technology is versus databases in general. And we will not be talking about 1,000 different cryptocurrencies. We'll see a lot more consolidation in that space. The things that we will be talking about, I think, is this social scoring, right to be forgotten type issues. These will really come to the fore in the next 5 years, and they will scare the heck out of people. And I think on a more positive note, we will be talking about identity, 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 identity. And the ideas that we have now are going to be supplanted by slightly better ideas going forward, but it will be the name of the game in this space. More broadly, I think we're going to be talking about technology and what it is doing to work and employment. And this is sort of almost a banal thing to mention right now, but I do think it's going to be the discussion for the next decade.
My friend Dante Disparte always says that we'll know we've succeeded when we stop talking about blockchain, and I think there may be some truth in that. Greg.
Look, I think we're going to be talking, I agree a lot with what Stacey said. I think we're going to be talking about activities, not institutions. I completely agree. I think that's finished. Secondly, I completely agree. I think we're going to be talking about artificial intelligence and privacy. I think that is just, we're just starting, and it's going to scare a lot of people. So I do think that is going to be critical. I do think we'll probably be talking about basically the stability risk of big tech attacking the banking system, which I think by then they'll be well and truly there, and what is big tech will probably have changed dramatically. And I think also we're going to be talking about fragmentation. Fragmentation, I think, is a massive, is going to be a massive issue because, for example, you look at the issue of privacy, the approach in Europe versus the United States, or you look at China, it's completely different. It's fragmented. And I think we're going to see this across a lot of the areas that I've just talked about.
Caroline, take us home here.
It is hard to be last. I think that in 5 years from now, we're still going to be talking about the income distribution and income inequality. And so I think we will be needing to face the ideas of what actually is a public good? What does every citizen have, or, need to have access to, like roads and electricity and those types of things? I think the technological part is going to become part of that conversation, and we really haven't had that yet. We've talked about it as a private sector thing, not necessarily as a utility, and particularly given that I think there's a lot of concentration in this technology space, that's going to be one important conversation, and I don't think anybody's come down with the right answer on that. It's going to affect central banks because a means of payment, the cash that you have in your pocket or you may not have in your pocket, is becoming less and less used, and so this idea of a central bank digital currency, who has access to the central bank balance sheet, is going to be right up there. Another thing is going to be these ethics questions. Not so much to do with DLT, but to do with AI and machine learning and other applications. We've kind of let the techs kind of go with it, and the quants go with it, the data quants go with it and say, okay, see what you can come up with. But there's hardly anybody out there, although it's starting, of people to think, well, what do we think as a society is right and wrong with this? What are the right choices and the wrong choices? And how does that affect actual people? Who's included and who actually is excluded? You touched on that. And I guess finally, this idea that we have some big institutions that are becoming quickly too big to fail. I'm hoping in 5 years that's not something that we'll have to actually deal with, but I think that conversation of what does it mean for regulatory oversight will be continuing. It's already started, but it's a tough question.
Well, it's tough to add to that very impressive list. I'm going to put my vote for the alignment of long-term investment capital with the long-term goals of an economy and how we can utilize these technologies. And here I'm borrowing from my friend Scott Kalb and the Responsible Asset Allocator Initiative, but how we can use these technologies to better align the resources that we have available with the challenges that society needs to address going forward. All right, with that as our foundation, we would invite any of you that have questions to please come to the microphone. We will take a couple at a time in batches if we can, and we'd ask you to please keep your questions pithy and make sure they are questions, if at all possible. Please.
Thank you for a very informative section. My name is Femi Akibi. I'm from Nigeria. My question, I call the destructive technology God sent to the African continent. My question is, what are the low-hanging fruit application for developing countries in Africa and other places that could use this application to solve problems in area of corruption, identity, procurement, and in some area, project management? How could we apply this at a local, national level and at an African continental level? We have 43 or so currencies that are worthless. We're looking for how do we leapfrog from lack of soft infrastructure and hard infrastructure with the technology available. Thank you.
Wonderful question. I like it so much. I'm going to jump in on that one in a minute, but please go ahead.
Hi, my name is Christian Peroni. I'm a Fulbright scholar here at Georgetown Law, and my question is, you mentioned a lot about your concerns related to privacy, and some of you mentioned about fragmentation. So my question is, do you think the solutions are coming from a domestic regulation? And if they're not enough, how do you see to propose for a more regional or international solutions in this scenario? Thank you.
Great. Please.
Good afternoon, ladies and gentlemen. My name is Rosemary Segero. I'm a president of a company called Segero's International Group. Thank you so much for your presentation. Looking at the new technology, FinTech, blockchain, and whatever. I come from Kenya. Kenya was the first country in the world to digitalize financing, the way she said. Do you think FinTech and blockchain is different from M-Pesa, or the big guys are the ones using the FinTech and the blockchain? So what would be the local common man in terms of the actual M-Pesa in Kenya and other countries that are coming, looking at what Mr. Femi has just said? That's what I wanted to say. All this money technology is coming. How do we change this into one currency of digitalized money other than just FinTech, blockchain, and everything snatching away from the common man? We use it just digital financing. Thank you.
Great. And one more, please.
Hi, my name's Fiona Stewart. I work with the Pensions and Insurance, the long-term finance team here at the bank. My question is, one risk that wasn't mentioned was the energy, the environment. And in 5 years' time, will we be talking about the energy impact of these technologies? And to get out of silos, should we have an energy specialist on this panel as well as a financial regulator?
Great questions. All right, let us begin with the application of blockchain in the public sector. Did you have one more? Quick one? All right.
I would like to ask about the STOs, securities token offerings, and to know the view of the panelists about it, about the increase of this, the usage of this instrument, and if they see a secondary market being authorized by the authorities in the countries, especially in the US.
So in the minutes that we have left, we are going to try to allocate these as equitably as possible among our excellent panelists. I am going to suggest, if there are no objections, that Greg, would you be willing to tackle STOs? You knew that was coming. And Richard, can you help us out on energy? Would you be willing to take M-Pesa versus blockchain, Stacy? Does that work? And then I would love to do a little bit on public sector and blockchain. And can you tackle privacy for us, Carolyn? All right. So with that as our marching orders, would you be willing to kick us off on privacy?
Sure. I think, you know, if what was being referred to was data privacy, I think to actually, I'd like to broaden it a bit, because I think to make all the gains that we need to make when it comes to technological advances, whether it's blockchain or any kind of other digitalization, you know, every country needs to have a data strategy. And the data strategy encompasses data privacy, of course, but it also encompasses data control, as well as use and access that other companies might have to it. And you know, we know that really well in Canada. So just one application, when you think about this, is looking at open banking and to the extent to which people can port their data and how easily you can do it to other financial institutions. Of course, Canada is not the only one looking at that. But to me, it's at the foundation of any kind of digital world. You know, in terms of actual applications with respect to DLT, well, governments are full of ledgers. There's just one ledger after another. And so whether or not it's in healthcare or any other kind of service, there's certainly a lot of applications. I would say that, you know, my view, and I think the rest of my Bank of Canada colleagues would agree, is that, you know, what we're aiming for is greater efficiency, greater interoperability, and greater safety with respect to information. And blockchain and some versions of DLT may satisfy that requirement, but it's not clear that they will. And that's why we're in the experimental stage. And I guess finally, if I go back to data and even to the applications, I would say just how important it is that different countries and jurisdictions actually talk to each other, because these are global. If we actually want to reap the benefits, we want it to be safe, but we want to reap the benefits, you can't have every country with a different data standard and different privacy requirements, ownership. You know, every country is going to want to put their own stamp on it, given their legal environment and their social preferences. But nonetheless, these companies are global. And so all you do when you have fragmentation in regulation is increase the cost. So a lot of work ahead, but certainly I think that the FSB, IOSCO, and others are making good progress, actually.
Fantastic. Greg.
You wanted me to comment on ICOs?
Yes, which is not a task for the faint of heart, but we know you're the man for the job. STOs was the language used, so an updating of the vernacular.
I'd call them initial token offerings, all right?
Yes.
But look, we did publish research on this 2 months ago on examining the ICO market and advice to policymakers, and I'd recommend people, if they're interested, to go onto our website, Initial Coin Offerings and Capital Markets. But basically what we saw was that, it's a very good example, as I said, of, the market was it was the Wild West. And basically, the lessons from it is that it didn't apply the sort of, back to my earlier comment, the normal market disciplines that you'd expect, or investor protection disciplines that already exist in markets for securities offerings. So many of the lessons that have been learned from it really were already adopted in normal securities markets. So and I think that's why securities regulators are now saying, well, their securities offerings, generally they're probably collective investment schemes, and therefore the disclosure requirements that are required to be made in respect to the offerings are normally what you'd expect. In terms of the trading of them, for example, people who created initial coin offerings didn't disclose how much they were holding back, or, that they were perhaps doing insider trading to inflate the price, for example. So you had a lot of fundamental stuff that, normally is illegal, that was going on, and the price of them, it was really quite questionable. The other aspect, if you look at it with initial coin offerings, is 95% of them are actually settled using Ethereum or Bitcoin, and a lot of the the issues were actually just people recycling profits from Bitcoin or Ethereum. So you had there was so many, if you want, it's almost like a test case for what can go wrong with an innovation, and why, back to my earlier point, regulators need to be ahead of the game rather than behind the game. And I think, frankly, we fail on initial coin offerings. And I can tell you, a few years ago, having been at ISCO, when we raised this, I said, we actually said there's nothing to see here. So it was a really good, I think, lesson to learn that actually you've got to be ready so that if it does take off, it doesn't go crazy. And I think what we've had more than 20 billion raised from ICOs. So yes, a lot of lessons to be learned, as always, from something like that innovation. But equally, I'm actually still positive that what can reshape from that, if properly regulated, could actually be a new form of capital raising for the future. So again, don't throw the baby out with the bathwater, learn the experiences, and that's what industry wants now. It's quite funny, you have people coming begging, wanting to be regulated. It's quite amusing, because they actually know that it's actually back to trust. And often what people know, that consumers and investors gain trust from knowing that something is regulated. And I think sometimes it takes perhaps entrepreneurs a while to recognise that actually it's not a bad thing to be regulated.
Great point. Please, Stacey.
Just on that, I don't even think that regulators need to pay that much attention to regulating ICOs. I mean, it's like a new currency that's come out of nowhere, and it's like caveat emptor, you know what I mean? The coffee is hot, don't pour it in your lap. They're just creating a new currency. You want to buy that? That's up to you. Anyway, that's just my view. So on this question of, we've got the blockchain and we've got these FinTech and different things, why don't central banks just go digital and just have a digital currency? Unfortunately, that is a very technical question, and I'm going to give you a slightly more technical answer than you probably wanted. But let me just say a couple of things. First, on the fiscal side, I think the digitization will definitely bring down the cost of welfare delivery. So that's an absolute advantage. I think it also, and I'm sure Tomika will talk about this, it minimizes leakages in the system, and that's a very important component as well. In terms of monetary policy, right now the problem with kind of digital currencies existing next to fiat currencies is that they can thwart capital controls if you want to put them in. So from Monetary Policy Authority, you're losing kind of control over your own money supply dynamics. And it also leads to, the term is a dollarization of the economy, and it could lead to coinization, maybe, I don't know is the word, of the economy. But from the central bank's point of view, I would say there's a couple of good advantages to having a digital currency. And this is not Bitcoin, right? I mean, the central bank is not giving control up over this digital currency by any means in this example. But I would say there are two fundamental advantages to the central monetary policy authorities. One is that you get a much better insight into the demand for money. So you're trying to make policy, that's very important. And also, and don't, you know, you could have negative interest rates on your money. And I'm not going to go into that, but this idea that if you really need to boost the economy below a rate of zero rate of return, you could actually charge people for holding money. And so that's not available when you have a cash. You have a zero lower bound in a cash economy. The disadvantages, though, are numerous, but I will just tell one. In a financial problem, if you can hold central bank issued money directly, you may flee the banking system. So ironically, a central bank issued digital currency can be bad for financial sector stability in ways that, you know, we don't exactly understand how they will play out. So maybe I'll leave it at there. I'll leave it there, I guess. Yeah.
Carolyn wants a quick rebuttal, although we are almost out of time. Carolyn, can you give us a 30-second rebuttal?
Just really quick. I totally agree with the pros and cons. I would just nuance the flee from the banking system, because right now you have contestability. It's not as perfect with cash, and I think we need to think of the double-edged sword, the two sides of the coin with respect to a central bank digital currency allowing fleeing from the banks if there's signs of trouble. Certainly banks need to know that there's somewhere to flee, otherwise they might not have the right incentives to manage their risks. And so there are two sides. And I also think the design issue is really important in terms of how easy it is to flee. So if there's an account at the central bank, that's one thing. If it's a token, like a card with limits, it doesn't pay interest, it's another thing. Yeah, so it's just important. But you make really good points.
Yeah.
Richard, 45 seconds on energy, if you can.
45 seconds. So I've got three things really quickly. The questions about use cases. There's a gentleman from Nigeria asked a question in Africa. Don't start with blockchain. Start with the problems it might be able to solve, whether it's tamper evidence or bringing people into sync. Don't allow yourself to be browbeaten into believing that it's the solution to everything. It clearly isn't. Be very precise about what it's for, and then figure out whether it solves any problems you actually have. STOs, completely agree. Interestingly, the people who now want to follow this idea of an ICO but do it in a regulated fashion, the amount of inbound I'm getting for people wanting to do it with us because of the way we built the platform is really quite interesting. Exactly to your point, people want to be regulated. And then finally, to energy, I should have been clearer about this up front. The public blockchains like Bitcoin, Ethereum consume a colossal amount of energy. You know, it's insane. Perhaps obscene is the word to use. They do it because there's a design principle or a requirement, if you like, that the people providing the consensus service be anonymous and be able to come and go at will. If you look at the requirements we have, you know, whether it's the financial sector or business in general, we do not have that requirement. We want to know who's providing the confirmation services. We want to know who is taking responsibility for providing finality. We want to know what they're governed by, which jurisdiction they're in, and how we sue them if they get it wrong. We do not have the requirement for the problems we're solving, and I suspect the problems on the rest of this panel, for this an anonymity of the consensus providers. And therefore, the platform I work on and the platforms that other people are using do not consume all that energy because it's not necessary. So you're right, the public blockchains, many of them do, for the problem they're solving, but it's not the one that I think is of certainly of relevance to my business. I agree. That surely doesn't appear to be sustainable.
Well, with that, let me please.
The thing about innovation, and I love innovation, but one thing is markets recover, consumers and investors don't necessarily. So you can have a laissez-faire approach, but at the end of the day, when people get hurt and they lose their life savings or they're affected, they don't recover. And I think we've got to always remember this. That's why you end up having regulation, and you should never forget that.
And on the point raised by our friend from Nigeria, what we are seeing is a great deal of activity to build out modular interoperable platforms that utilize these technologies to help power the public sector. That's an effort that I'm helping to lead together with the Rockefeller Foundation out of New America, and we're working with jurisdictions around the world on that project. We'd love to discuss it further. It's important because if you get it right, you're able to capture a significant portion of the $3.1 trillion a year that are are lost to corruption and malfeasance around the world, and also a significant portion of the roughly 3.4 trillion that are lost as a result of poor tax compliance around the world. So you get it right, you solve the SDGs, you fund the SDGs, which is something that hopefully all of us in this room can support going forward. I want to, as we conclude, and we are now right on time, thank our colleagues at the bank, especially Paul Snaith and Stella Moken, who helped to bring this together along with many others. The bank is at the forefront of this conversation globally, and they deserve a great deal of credit for that. And also thank all of you. These are technologies that by their nature are decentralized, and if we're going to use them effectively, it's going to require all of us working together to build trust, as we've heard about today. So it's a privilege to be here with all of you, a privilege to be here with you panelists, and please join me in giving them a great round of applause for their insights.